One of the things I like about commercial real estate is that the numbers are big. You're not talking about trading assets that are worth $10,000 or $20,000 or $50,000 or $100,000. You're talking frequently about trading assets that are worth $5 million, $10 million, $20 million. And that attracts a certain level of sophistication that I really like to rely on. It attracts people that stand to gain or lose millions of dollars if they can deliver for their investors, and therefore it attracts people that are interested in making a lot of money, but also know, because it's very competitive, that they're going to be going against some of the best. And so the best and the brightest tend to work in this industry. At least one of the industries people tend to work in that are motivated by those factors. Now, we've talked a lot about $5 and $10 and $20 million purchases on this program, but we're going to talk today about the size of a deal, the likes of which we have never discussed. Our guest for today just recently closed a massive deal with a pension fund that has a lot of money at their discretion, and it's going to be allocated over the next few years. And we talked about it offline. I said, oh, wait, we need to talk about it on the show. So in today's program, we're going to talk all about this massive deal, closing $250 million of investment equity during a pandemic and the concerns around a pandemic. We're going to talk about how the capital markets, how the debt markets have reacted to the pandemic, and how this may impact the business going forward, and why our guest, who has the ability to live wherever he wants and work wherever he wants, has decided to live, work, and invest significantly in California. And it's a really interesting conversation, especially given the headwinds we're seeing from a political standpoint generally, but also as it relates to COVID. Very interesting conversation, a good friend of mine. Now, keep in mind, if you haven't yet signed up to invest with us at ASIM Capital, make sure to do so. We are so close to putting out a deal that I've been working on for months and months and months and months. I think we're less than 30 days away right now, and it's going to be one of those deals that fills up very quickly. So if you're not yet on our list, you can't access our deals. They're behind a password protection wall. So go over to asymcapital.com. Again, it's only appropriate for accredited investors. Head over there, create an account, and then once this new deal is available, we're going to send it out, and you will be the only people that have access to the deal. Like I said, you will not have access to it if you're not a member of ASIM Capital. All right, hope to see you on the inside. How's it going, everyone? Our guest for today is Chris Tourtelotte, who serves as Managing Director of LaTerra, where he's responsible for overseeing the development group, sourcing and closing new acquisitions, sourcing the debt and equity for LaTerra's projects, and growing their apartment and mixed-use development platform. And get this, I want Chris to confirm this, they have more than 3,000 apartment units either under construction or in the pipeline. Not the portfolio value, that's actually deal flow, is that right before I even go any further?
Yes, it is. Yes, thanks, Hunter. It is correct. We've got about 3,000 units in the pipeline, which could mean in the entitlement stage, pre-development or under construction. And really over the last 5 years or so, we've grown into one of the most active, if not the most active, apartment development companies in Southern California.
Love hearing that. Well, give us a little bit more context. Obviously, you've been on the show before. We'll link to those 2 episodes, I believe episode 3 and episode 63, something like that. We'll link to it. But for those that didn't hear those episodes yet, just a quick summary of the firm and how you guys are positioned in the market.
Yeah, thanks. So LaTerra Development is a residential and mixed-use development company. We're based in Century City in Los Angeles. And our business model has historically been to buy land, process entitlements or approvals with the respective city, which we think gives us a good land basis. And then we'll put that land into a venture and build the residential and mixed use property. We don't always take entitlement risk, and we're smart about the way that we do it. We like covered land plays. We buy land that has the underlying zoning in place, which we call entitlement risk light. And that allows us to effectively tie up sites off market and compete in a way that our competitors can't. And then we build these residential and mixed use properties. We've got properties throughout Southern California in markets like Santa Monica, West Hollywood, Los Feliz, Burbank, Echo Park, Silver Lake. So we're quite active.
Very cool. And I do want to talk a little bit about big picture stuff, where you see this is going 2021, 2022, et cetera. Before we do that, though, I just want to add some context. Prior to the realization that COVID was going to play a significant role in the U.S. economy and in U.S. real estate, what was your deal flow, let's say April or March of 2020?
Yeah, sure. So things were looking good. Really, it was, let's say January, February, first half of March 2020.
Sure.
The capital markets were flowing. Yeah, we had multiple equity and debt term sheets for every deal that we brought out. Lenders were getting super competitive, especially with regards to interest rates, which were low, their ability to fund earlier on in the pre-development process. Equity capital partners were getting more creative. And frankly, there was billions of dollars actively competing to invest in real estate. So things were frothy.
Yeah. And so now we've kind of opened this Pandora's box to a large degree. How have things changed in that realm, both in the capital market side, the debt side, and from the equity side?
Yeah, sure. Good question. So it's interesting. The debt markets are like a light switch. Either they're on or off. And I can almost pinpoint it to a specific day, which was when the NBA was canceled due to the pandemic. And that was really the exact moment the light switch turned off. And the 60-day period starting mid-March was dark. Now it feels kind of like a dimmer switch and it's getting turned on again. Lenders are mostly focused on providing debt to borrowers where they have existing relationships, borrowers who will establish depository relationships at the bank, like deposit, their personal cash or business cash at the bank. Mm-hmm. But the debt markets are starting to open up, which is good. But still, proceeds are down, meaning lenders are providing a lower amount of debt relative to cost and value. And rates are up, interest rates are up, spreads are up, so it's more expensive. There's debt funds. They're active. These are funds of money, not banks, but funds where folks invest in the fund. And the purpose of the fund is to lend money. And the debt funds are typically looking to invest in bridge debt and in some cases, construction debt. And I kind of call that 10 and 2 money, 10% interest rate with usually 1 point in and 1 point out. Debt funds can invest at higher proceeds and get much more creative. The issue is the capital is expensive. And some of the funds are loan to own, meaning if you slip up, these funds will foreclose on the asset at what they think is a lower basis, as opposed to kind of working through the issue. So it's important to know, who you're borrowing money from, and generally this is expensive capital. So that's kind of the debt fund market. And I've found that like New York City based fund managers have not been as active. I think that's maybe because the virus was worse in New York City. So they kind of have a different view of the world than, say, an LA-based investment manager. But that's sort of changing. And then on the equity side, there's a lot of capital on the sidelines. And we can get into that in a bit. But I feel like the equity markets have changed as well.
Well, yeah, let's talk about it. I mean, I'm interested to hear, first of all, to provide some context, what are the types of investors that you're used to courting? Because I know it's not the typical investors that maybe some other people that are either been on the show or listening to the show may have a background working with.
Yeah, sure. So we work with a variety of different types of equity investors, but mostly it's what I'll call an institutional fund manager, right? So examples of institutional fund managers include like Prudential, Morgan Stanley, Blackstone, Goldman Sachs, Clarion, AEW, and on and on. And so these are fund managers whose investors are pension funds and sovereign wealth funds, and they manage money on behalf of those clients and invest in a variety of asset types. Opportunistic funds invest in development deals with LaTerra. There's core funds who buy office buildings and do repositionings and things of that nature. So that's a big investor of ours, is these institutional fund managers. And then we have family office investors as well. And those are really the two investor types. And then a third, which we can talk more about later, is a direct investment that LaTerra recently secured with the big pension fund. But that's generally who our equity investors are.
Yeah, great to hear. And I am very much looking forward to that part of the conversation. So how has their appetite shifted? How has their underwriting shifted to account for the uncertainty in the marketplace as well as the change in liquidity, which you alluded to earlier?
Sure. So as it relates to like underwriting standards, right? So there's a lot of capital on the sidelines, but from an underwriting standpoint, investors are now assuming flat or negative rent growth for the next 2 years, really in all asset types. In retail, it's really negative. In office, it's probably negative. Industrial is holding up better. Multifamily is holding up well, but still they're assuming flat rent growth for the next couple of years in their DCF models. And the other metrics are kind of staying the same, but the impact is meaningful to the IRR, to the internal rate of return, when you have zero or negative rent growth for the first couple of years. And if you're solving to the same return threshold, then that drives down land values. So we're seeing investors wanting at least 20% discounts to land values versus, say, February of 2020, and more in certain asset classes for sure. But they're all looking to achieve the same returns, and they're all looking for these discounts in the market.
Okay. And are those discounts happening? Or is there kind of a disequilibrium in terms of demand for those discounts and those discounts actually taking place?
Yeah, good question. So this is sort of interesting. Right now, everybody is looking for distress. And I like to point out that although I wasn't actively investing in this time, during the S&L crisis, the dot-com bubble, the Great Recession, there was no capital. Everybody wanted to do deals, but there was no capital. Liquidity seized up. And it was quite interesting. Now, every capital partner I speak with says they have a huge sum of money and they're waiting for distress. So there's billions and billions of dollars in liquidity right now on the sidelines looking for distress. Apollo's raising $20 billion for distressed properties. Blackstone, Starwood, KKR are raising billions. Basically, every LP or equity investor I speak with is sitting on a pile of cash saying that they're hunting for distress. So there's a lot of capital on the sidelines. And frankly, I don't think there's going to be a lot of distressed buying opportunities that everybody thinks there will be. So people ask, well, where is the distress? The main example is really the mortgage REIT market, debt funds that provided loans for hotels, retail, office, and other properties. They're facing some challenges. So many of these mortgage REITs and debt funds, although they are lenders, they actually borrow money at a low cost, let's say 4%, and then they lend at a higher cost, let's say 10%. And that arbitrage, that delta is their profit. But now these REITs, their lenders are doing margin calls on the actual mortgage REITs and debt funds. And what does that mean? That means these mortgage REITs, they don't have the liquidity to fund the margin calls because the asset values drop. Their lenders say, your asset value is down. You got to pay us the difference so that we can maintain the same loan to cost ratio. They can't make these payments. And so the mortgage REITs lenders are actually taking over those loans, the paper on those loans and the collateral. And so what happens is these mortgage REITs go out and they look for money to make these margin calls to their lenders. And so a big example that was in the press is that Starwood recently invested $325 million in TPG's mortgage REIT, because that REIT had meaningful hotel and retail exposure. And so that was kind of a form of distress, but this is a niche and there's billions of dollars for this strategy. So, another strategy, I think, will be buying hotels at steep discounts. The hotel hospitality market really got crushed during the pandemic and still is and probably will be until there's a vaccine. So I think there's a good strategy out there to buy hotels and convert them to multifamily properties if the underlying zoning exists. So we've seen some distressed hotel opportunities hit the market. These are shuttered hotels.
What does that term mean? Shuttered as in
it just means they're
closed down.
They're closed down, not operating anymore because their occupancy rates were 20, 30%. So it just didn't make sense to keep them open and maintain the staff, unfortunately. And so they're operating at a loss. And so they actually do better by just closing the doors. Which is unfortunate. And I think that'll generally be the case until a vaccine. Things are getting a little better. But frankly, on the multifamily side, property owners, they remember the values of February 2020, right? It wasn't that long ago. And so I think everybody's looking through their crystal ball and saying, hey, look, when there's a vaccine, things are going to get better. And so anyway, I just don't think we're going to see the discounts on multifamily land, especially in these good core markets that everybody's looking for. So it'll be interesting to see where the distress is and where it all plays out, but it might not be as abundant as it was in past cycles. And frankly, I think the bottom line is there's just too much liquidity sitting on the sidelines looking for distress. It's just very competitive.
Yes, I agree with that for sure. And I think that one thing I've tried to harp on is that we all tend to operate in little circles of our sphere of influence, people that agree with us, people that think like us. And if you are surrounded by people who
don't have any investments in real estate, for example, which most people, the average person in the United States, does not have any kind of investments in private placements, for example. You have a very skewed version of like what's possible in the world, what's actually going on. What's actually going on in the world is that there are literally trillions of dollars looking for great investment opportunities always. And the United States real estate, especially in desirable markets, is always in the top tier of what's possible. It's an incredible investment vehicle, and it's an incredible country in which to invest because of the combination of the stability of the laws, the tax laws, et cetera. Now, just as far as distress is concerned, I wanted to make a note. Several people sent me articles relating to the collections data in April in terms of mortgage debt. And in April of 2020, the mortgage debt that was past 30 days due soared to 3.4%, which is the highest it's been since 1999, up from 0.7% in April of the last year. So there could be an opportunity in the distressed debt space as well. And that's a space I'm not so interested as into the hotel market because of the cyclicality of it. But in terms of distressed debt and mortgages, it's something that's caught my eye a long time ago. I just wanted to mention that. Now, I want to address and get your thoughts on breaking ground or even in early stage construction or late stage for that matter in today's environment. This is something that your firm focuses on. How do you feel right now going into a project or trying to close out a project, bringing a project to market? What are your thoughts?
Yeah, so it's an interesting dynamic, right? Because I think now is a great time to be commencing construction, whether it's a ground up construction project or if the listeners do renovations or value add. I think if you can be delivering projects about 24 months from now, really even 12, let's say 12 to 24 months from now, to me, that feels really good. You know, the second half of, let's say, 2021, 2022 is better. So we remain bullish and active. We do want to get projects underway currently, but the flip side of that is it's just very difficult to get capital excited about starting new projects right now. Because as I said, everybody's looking for those distressed deals. And so the dynamics of what equity and debt investors are looking for is a little bit different today. But that being said, if you can be delivering a couple of years from now, I think it feels really good. So that's what we're looking to do. And we've got a couple of new big projects that are underway with that in mind. So I actually think it's a good time right now if you can get the capital together.
Okay, that's actually a good point. So you are currently pursuing deals, and there's even deals that you've recently closed that you're feeling very confident about. Is that an accurate summary of what you just said?
Yeah, yep, that's right.
Okay.
That's right.
Good to know. It's an important data point. So let's talk about this massive pension fund deal. This is something that you and I talked about offline. I said, holy crap, stop. We got to record this conversation. Walk us through how this happened, especially in today's environment. So start from the very beginning. Let's talk about how you were able to source this relationship and curate such an interesting and fascinating relationship and how that relationship ended up in a big deal getting done.
Yeah, thanks. I think this is, we're very excited about it. This particular closing was one of the biggest transactions to occur during the pandemic, and it got global press coverage really all across the world in dozens of publications. And so we were very excited about it. And I'll start with kind of what it was, and then I'll get into the background on it. But what we did is we closed $250 million commitment from a large pension fund out of Canada. And we had a couple seed deals, and it's a programmatic venture to go do more development deals in Los Angeles and greater Southern California. So this is exciting for us. I think the ultimate goal as a developer is to sync up with a single source equity partner. And as I mentioned earlier, a lot of these institutional fund managers, they raise capital from pension funds and sovereign wealth funds. So if a developer can sync up directly with the pension fund or sovereign wealth fund, as opposed to going through these fund managers, right? These middlemen, you're kind of going direct to the source. And I think that's a better relationship for the pension fund. They're paying one less layer of fees, right? They're not paying these fund managers asset management fees and shares of profits. And they sync up with the developer. The developer syncs up with them and gets great access to capital and good deal flow. So that's been our goal for quite some time. So how did we set out doing that? Well, this took a long time, frankly. It's not an easy or fast endeavor, right? But our pitch, as we went out looking for the single source bucket of capital direct to a pension fund, our pitch was that We are what I'll call a mile deep and an inch wide. What does that mean? So it means we're exclusive to Southern California multifamily development. We're not spread too thin, right? We don't say that we're developing apartments across the country, that we're in Southern California doing apartments and office and retail and industrial. We're focused on a niche and we're very good at it. And I think that is key. People are looking for specialty operators, investors are. And frankly, these capital providers are underweight in SoCal, especially Los Angeles multifamily. A lot of the national developers just haven't been able to execute as well on the local level. It really takes great relationships and long tentacles into the market in order to execute here locally in Los Angeles. So that was the pitch. We went out looking for this type of investor. It's good. Look, we have a good track record. I think it helps having some sort of a track record that you can point to. Obviously, the better the track record, the better. LaTerra, in this real estate cycle, we've successfully entitled 23 out of 23 land sites. So 100% success rate on our entitlements. And that's because we're smart in the deals that we look at. We don't take huge amounts of entitlement risk. But I don't think there's another local or regional developer out there who can say that. So we made that pitch and we went out and tied up some really good seed deals. So having good seed deals that you can feed into a venture, it really helps. It allows a capital partner to immediately get capital out and get the exposure that they're looking for. So, thankfully, we had good momentum going into the pandemic. Late last year, we got a term sheet signed and the capital partner had come out and looked at our sites and met the team, did a lot of due diligence. And then the pandemic hit, right? This was in March of 2020, a few months ago when the NBA got canceled. And I just remember thinking, oh gosh, this is difficult. But fortunately, this particular capital partner, they had a long-term view. We had the good seed deals, which I told you about. LA is a difficult market to get into. And so we ended up getting the deal done, worked through it and closed kind of in a staggered fashion and over the course of really May and early June. And then it was big news for us. Very, very exciting. So now we're out there looking to invest in Southern California multifamily. We have this new venture in place with this Canadian pension fund, and we're looking for deals, and we'll continue to grow our Southern California apartment development exposure through this venture. So very exciting for us.
Really exciting. I mean, it couldn't be more exciting. I want to kind of circle or double click, as one of my friends says, on a topic, because I think that some people may be listening to this and hear $250 million equity investment. Okay, that's incredible. What a cool story, but that doesn't apply to me. But I want to give you an opportunity to talk about the reality that the way in which you position yourself to attract that relationship is applicable to anyone. And more importantly, perhaps, to talk about their due diligence process, especially as it relates to the same kind of strategies that can be implemented to a single accredited investor, right? So I know that there's obviously due diligence processes and compliances issues that you'll go through with the pension plan that nobody in the right mind would go through as a $50,000 or $250,000 investment. But what are the two things in terms of both the relationship and in terms of due diligence that our listeners can really focus in on and apply to their own investing strategies?
Yeah, I think that's a good question. And frankly, look, anybody with good commitment and good work ethic can put together a business and raise capital. So, I want to encourage the listeners to go out there and do that. And I think part of it is having that specialty focus, which I mentioned, rather than focusing on too many different things, develop a niche and get good at it and try to get a little bit of a track record under your belt and then go out there and try to raise some capital around it. And the reality is that you're going to get a lot of no's. It's going to take some time. It could be 100 no's before you get the yes, just generally. But I think stay committed and focused. And I think any of the listeners out here have the ability to put together buckets of capital or funds or whatever it is they're looking to do to raise that capital. So I think it's about commitment. And I encourage, the listeners to do that. And, and ultimately they could be raising, $250 million in equity from a pension fund. So I remain optimistic, and there's always opportunity in the market. The opportunity changes, but there's always an opportunity. It just depends on the strategy and the location and the time. So that's my view. And as it relates to due diligence, I think on the asset level, we focus on rents, costs, and then, other due diligence like environmental due diligence. And that's really, the pension fund, they did very thorough due diligence on the company and our deals and the principles and our track record. And they're very, very smart and thorough. But from a property standpoint, they do rely largely on the local operator because we're the ones with the boots on the ground who know the entitlement processes, who know the cities, who really have an intimate understanding of the local market. What are rents? Why is a certain product in a certain location going to do really well? It doesn't always make sense on paper when somebody from New York or a different country or a different state looks at the location or uses Google Earth. But from a micro location standpoint, the local operator knows and just knows, to their core, that this is a good location. This is a good strategy. This is a good neighborhood. These are the renters or the tenants or the demographic that we're going to attract. And I just know it. And so getting that message across and being confident, I think is really, really important. And then ultimately, from a due diligence standpoint, you do need to prove out the rents in your business plan and construction costs. And super important to look at environmental risks. But I think with all of that in place, I think an investor can be prudent and really drum up some good deals and raise some capital around it.
Yeah, I actually really agree with that. And I recently spoke to a group of very savvy, probably the most savvy and sophisticated group that I've ever presented in front of. And it was interesting because they want the data, they want the specifics, they want not just the thesis, but they want the actual pragmatic approach to investing, and which I love, and I'm obviously very sympathetic to. That's why I do the show. But at a certain point, if I'm being honest and transparent, I can give you data. I can give you a theory, and I can back it up by all the data because I have access to every single thing in the world through both relationships and through just being able to Google it. But here's what matters more than any of that: our relationships. Our relationships with strategic partners that we trust. They're the ones, to your point, LaTerra has such an amazing amount of insight when it comes to SoCal development that if I know how to pinpoint LaTerra, then I can back up all the claims I want, however I want. But at the end of the day, if LaTerra comes to me and goes, hey, look, this is a great infill position, we think we can convert this to units as opposed to industrial, hey, guess what? It's not my expertise that's getting me that decision. It's a deferral to someone else's. And sometimes I got to be honest about that. And I think it's a good point you bring up there. So let's talk again about going through the closing process, because obviously during some time you probably thought, holy crap, there's no way this deal, of all the deals, there's no way this deal is going to get done. Did you ever hit that wall where you either went to bed thinking, what am I going to do tomorrow? Or woke up thinking, this is going to be the day they bail?
Yeah, it was a very dark period of time. And not to say that things are rosy now. There's certainly challenge ahead. But I still go back to the day I was sitting in the office, and later that night, the NBA got canceled and the stock market was dropping. The Dow was down 10% a couple of days in a row. And things were very dark and gloomy. And I did wake up and say, oh my gosh, what's going to happen to this deal? And then later, businesses were closing down. The Safer at Home ordinance was put in place in LA, shelter in place in San Francisco. And frankly, we had to ask ourselves, wow, is construction even going to be allowed to continue? And fortunately for us, construction of housing was declared an essential business given the housing crisis in Los Angeles. So our construction projects were allowed to continue. We put in place safety measures on site and subcontractors wearing masks and hand washing stations and social distancing and things of that nature. But fortunately, construction of housing was declared an essential business. So that was really helpful for us. And being in LA and a good product type and a good market with supply constraints was helpful to us. But yeah, I did. Going as of February, I thought to myself, wow, this deal will happen, and we've got a lot of great momentum, and probably nothing could stop it, right? Not even war in North Korea, for example. But then again, as the NBA got canceled, I did say to myself, oh crap, I don't know what's going to happen. But we remained focused, calm, and diligent. We reminded ourselves the most important thing was that our employees, our families, our workers, our friends were safe and healthy. That's the most important thing. If you have your health, and you can stay diligent and calm and focused, hopefully you can have some success. And we are fortunate that we're in the right place at the right time, doing the right thing, being LA Apartments. But yeah, it was a difficult time, but we had fortitude, and also we had these great seed deals that we've been working on for quite some time, and they had a good cost basis, and we're in good locations, right? And so it was difficult, it was challenging, but frankly, we had a great partner, a good commitment to the area, long-term view, and things worked out. So I think with the hard work and good efforts, it got done.
Agreed. There's obviously been a massive shift, not only in terms of the economic activity, but in terms of people's, thought process about how to spend money or how to spend their time. Even if it wasn't related to government requirements, there's been a pretty big shift in terms of things like traffic data, for example, or people's interest in going to restaurants in places where they're allowed to do so. How do you feel like this may impact the multifamily business, especially in SoCal, over the next, let's say, 2 years, 4 years, 5 years? Or do you think that this shift is going to be short-lived and in 9 months, let's say, or post-vaccine in particular, that this will kind of be a relic of the past?
That is a good question, and a couple different components of it. I mean, I think generally, once a vaccine is widely distributed, people will largely go back to their pre-pandemic behavior, right? Like the Spanish flu of 1918 didn't cause, permanent changes, in my opinion. People are still going out to eat today, right? But there are changes to the way in which multifamily communities are going to be designed, and you can apply that same logic to office and industrial and other asset types. But multifamily is an interesting one. So I'll give you a couple examples of design changes and behavior changes that I do think will be permanent, and how we're implementing those into our multifamily communities that we're either designing today or frankly even building. We're making some changes. So a few key examples, fitness centers. I think you're going to see more outdoor areas for yoga mats and just generally other kind of outdoor exercise. So maybe accordion doors with an indoor-outdoor fitness center concept in these apartment communities. Just being outdoors generally feels like a better and safer place to work out. And we think more people are going to work from home. Morgan Stanley recently announced 5% of their workforce will work from home on a permanent basis. Whether that's in shifts or different divisions is to be determined. Obviously, these tech companies you're reading about, Google and Twitter and others and Facebook saying that they're going to have, a bigger work from home component probably forever. And I think that's just the world that we're in. And so what does that mean? Well, it means that we should be designing more 1-bedroom and 2-bedroom units with dens, i.e. home offices, so areas for people to work, right? That's a big one. Patios and balconies are much more valuable. Think about how many renters are sitting in apartment communities, whether it's LA or New York City, where they don't have a patio. And for months, they were sitting in their units, having very little opportunity to get some sun, to read a book, to have a glass of coffee or wine outside, right? And so these renters are kind of scarred for life. And as a result, I think when they walk into a unit, they're going to want a patio, right? That's going to be important. So those are becoming a lot more valuable. Co-working spaces on site will become an important amenity. So we're designing these in every project, especially if you can have an indoor-outdoor co-working space. So that's a big one. I think 3-bedroom units should have 3 bathrooms rather than 2. So that's another one. And then just generally, I think as we think about community spaces and outdoor spaces, people are going to want to have areas to congregate with 2, 4, 6, 8 people, their friend group, in a more intimate setting, as opposed to 30, 40 people that they don't know. So we're designing our rooftop decks and other spaces with more cabanas and smaller nooks and areas for smaller groups of people to hang out. So I think that's a permanent behavioral change as well.
Yeah, I like that a lot. And also the developers are obviously kind of predicting the future in terms of that kind of social dynamic. So very interesting. We'll see that play out over the next 2 or 3 years as these units are brought to market.
Yeah.
California has had a pretty pronounced reaction to COVID, but also there's a lot of tailwinds regarding some of these things even before COVID. And I'm talking specifically about, evictions or rent control, these types of things, which are constantly coming up on the ballot. You work specifically in Southern California. What are your thoughts on, first of all, the state of those initiatives, and also how you think this is going to play out and how that may affect your business going forward?
Yeah, good questions. I'll touch on a couple of these propositions and other measures that are either on the ballot or in place, and kind of give you my thoughts, because I think that's important. And then some kind of thoughts just generally on how investors and others are viewing California opportunities here relative to other places around the country. So an important one is Proposition 21, which will be on the ballot this November 2020, and that effectively overturns Costa-Hawkins, which in turn allows cities to implement rent control. You may remember 2 years ago, there was an attempt to repeal Costa-Hawkins. This was November 2018. That was Prop 10. You maybe heard me say vote no on Prop 10. Prop 10 lost by a landslide, fortunately, with every county in California voting against it. The AIDS Healthcare Foundation, Michael Weinstein, is behind this. So you have the AIDS Healthcare Foundation president spending AIDS money on anti-housing propositions, which to me is quite odd. But fortunately, Prop 10 did not pass. I do not think Prop 21 will pass, which will allow local jurisdictions to implement rent control. So hopefully that doesn't happen. I say vote no on Prop 21 on this podcast. It's supply and demand, right? If you implement price controls and rent controls, there's going to be less incentive for investors to take that risk, and they'll just look elsewhere. So you're going to have a supply issue. What you need is to add supply to the market. The more supply of housing, the lower you're going to see rents drop, right? Supply and demand, Econ 101. So that's an important one that we're watching. There's been some discussions for the repeal of Prop 13, which would allow taxes to be adjusted to market on an annual basis on commercial properties. I hope that doesn't get passed. I think that what you'll see is potentially a slippery slope where then residential properties and single-family homes are up next. But in any case, it's important to remember that retail tenants, right, the local mom and pop stores, their leases are what's called triple net, meaning they pay rent, but they also pay their pro rata share of taxes and insurance and other costs. And so if taxes go up, you're going to see a lot of these small businesses going out of business because they're not going to be able to afford the rents and the taxes. So that's another thing to keep in mind. And I'll touch on one more, which is AB 1482. A lot of folks recognize that passed in California at the state level, put into law by Gavin Newsom. I think that's more reasonable. What he said is if a property is 15 years old or older, rent growth is capped at 5% plus inflation, which is kind of like an annual increase. And then if a tenant vacates, rents can be adjusted to market, right? That's called vacancy decontrol. And that is a more reasonable measure that I think Gavin put in place to get out ahead of Prop 21. So it's an interesting world, right? And then lastly, not to get too technical, there's something else called AB 1436, which would basically bar landlords from evicting tenants for up to 90 days after a state of emergency is lifted, and would prohibit landlords from evicting tenants and give those tenants 15 months to pay back rent. And so while I support tenants, especially during the pandemic and people, it's a very, very difficult time. I guess it's just important to bring awareness to the fact that landlords who own properties, they have to pay taxes, right? The tax bills keep coming. Insurance, they have equity partners and lenders and interest expense. And it's kind of like an ecosystem, right? And so it's important to keep in mind that landlords have these bills to pay too. And if they don't receive their revenues, the whole ecosystem can be broken. And one last comment is that I think listeners should know and the community should know that a lot of these funds of money that are invested in real estate deals, that's pension fund capital. Those are people's individual pension funds and retirement accounts. And so, if you just say, hey, tenants should stop paying rent, at the end of the day, you're going to see equity investors and pension funds, impacted people's retirement. So that's kind of my view of the ecosystem. But to kind of address your second point, all right, so we've got all these bills and initiatives and controls in California. How are investors viewing California, right, with all of this kind of murkiness in the future? And my answer is our commitment to California remains unwavering. I talk to investors who say, gosh, we have sat out on California since like the 1980s because there has always been this discourse and discussion about political headwinds and price controls and rent controls. And so these investors have sat out. And over the last several decades, California has just continued to outperform. I think it is and will remain one of the most desirable places for people to live, work, and play on the planet. So we navigate the headwinds, we look at ways to mitigate it and try to find opportunities. But I think we're committed to California. It's a great market to be in. And I think generally the world views California and Los Angeles in particular as one of the best markets in the country, despite all that noise.
Hey, well, I'll be honest. I have the ability to work wherever I want. and have decided to work in Los Angeles, and probably for a lot of the same reasons that you do. So, Chris, we covered a ton of ground. Congratulations again on that massive, massive deal. I'm interested to see how this continues to play out, and we should definitely do it again in 12 months or so once more of these deals have started to close and things really start to open up, especially as it relates to liquidity. Before we jump off, though, let the listeners know how they can learn more about your firm and what you guys do.
Yeah, absolutely. And so, you can type LaTerra into Google and learn more about our 2C deals with the pension fund, which include 573 units in Burbank. That's, $275 million project that we spent multiple years entitling, another project in West Hollywood. If you go to our website, LaTerraDev.com, LaTerraDev.com, you can learn more about our company, the principals, and our portfolio of deals across Southern California.
Awesome. Well, Chris, thanks again. Really appreciate it.
Yeah, absolutely. Thank you, Hunter. Appreciate your time.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.